Welcome to this explainer. In the high-stakes world of corporate strategy, every single decision you make is basically a calculated move on a deeply complex board. Today, we're skipping the basic theory and decoding the ultimate rulebook that top-tier organizations actually use to plot their moves, manage their assets, and corner the market. It takes foresight, immense precision, and a ruthless understanding of the rules of play to dominate an industry. So let's look at exactly how executive teams structure their path to victory.
We're going to break down the strategic playbook into three distinct phases today. First up, formulating the strategy. Second, the 4 strategic moves. And third, portfolio management tools.
Okay, let's dive into this. Phase 1, formulating the strategy. This is where we set the board. So, strategy formulation? It's fundamentally an analytical stage. It's the rigorous groundwork that absolutely has to happen before a single dollar is spent or a single product is launched. Think of this as your critical reconnaissance phase. History is literally littered with multi-million-dollar corporate flops, ill-fated hardware launches or catastrophic international expansions. And they happen simply because leadership skipped this step. You have to define what victory looks like, scan the competitive battlefield to see exactly what you're up against, and then ruthlessly weigh every possible path to the finish line before making a move. And this analytical groundwork? It actually follows a really precise, logical flow. Step 1, set objectives. What exactly do you want to achieve? You need crystal clear targets here, whether that's hitting a specific revenue milestone or capturing, say, a certain percentage of market share. Step 2, assess environments. This is where you look outward at macroeconomic conditions, but also inward at your own operational realities. And finally, step 3, choose alternatives. Out of all the potential paths forward, which is the absolute best one to take? This exact sequence ensures that every subsequent move you make is highly calculated and deeply intentional.
Moving right along to Phase 2, the 4 strategic moves. Time for the emerging strategies.
All right, so the first strategic move is all about aggressive, expansive energy, growth. When an executive team decides it is time to scale up and capture more territory, they rely on specific growth strategies. This might be market penetration, really pushing harder into the spaces you already occupy with aggressive marketing or pricing. It could be product development. Think of Apple launching the very first Apple Watch, right? Creating an entirely new revenue stream from an existing user base. Or you pull the trigger on mergers, instantly multiplying your footprint. It's like when Disney acquired Marvel. Literally overnight, they bought an entire universe of intellectual property and completely transformed their market position. A real game changer.
But listen, a constant, relentless attack just isn't always sustainable. That brings us to our second move, stability. In stark contrast to the aggressive expansion of growth, a stability strategy is all about steady, calm, and incremental improvement. Because sometimes the smartest play isn't to conquer new lands, but to fortify the castle you already have. Consider a major software company that pauses its rollout of flashy new features for a whole year, purely to fix internal bugs, optimize its supply chain, and improve customer retention. It's about careful, continuous tweaking, optimizing your current operations, and just holding your ground effectively before making that next big push.
Now, what happens when the market turns against you, or internal failures threaten the entire enterprise? Well, that leads us to the third move, retrenchment. This requires a serious, highly focused triage. Retrenchment involves recognizing hardship and making the incredibly tough cuts necessary to survive. A classic example here is Steve Jobs returning to Apple in 1997. The company was hemorrhaging money, so he instituted a massive turnaround effort by slashing the bloated product line down to almost nothing just to save the core business. Retrenchment might also require divestment, where you sell off underperforming parts of the business. Or, in the absolute most severe cases, liquidation, shutting down entirely to salvage whatever assets remain. It is a strictly defensive maneuver, sure, but absolutely vital for long-term survival.
Now, what's really interesting here is the powerful contrast between that defensive retrenchment move and our fourth and final strategy, diversification. While retrenchment is the harsh reality of retreating from risk and shrinking your footprint, diversification is proactive defense through expansion. By entering completely new markets or developing entirely new product categories, a diversification strategy spreads your risk around. It operates on the logic that if one sector of your business takes an unexpected macroeconomic hit, well, your other, diversified interests act as a financial shield. You are essentially protecting the larger corporate entity by ensuring no single failure can sink the whole ship.
Which brings us to Phase 3, portfolio management tools. This is all about allocating resources.
So you know the board, and you know the 4 possible moves. Now you have to categorize your assets to decide which move applies where.
The BCG matrix is a classic framework for doing exactly that, bucketing diverse business units into 4 distinct categories. First, you have your stars. These are the high-growth, high-market share powerhouses driving your future. Then you have your cash cows, the steady, reliable earners that you milk to fund your wilder ventures. There are the question marks, high-growth but low-share gambles that require some really careful consideration before you pour more capital into them. And finally, the dogs, the low-growth, low-share areas quietly eating up your budget. And actually, these might be prime candidates for that retrenchment strategy we just discussed.
But, the BCG matrix isn't the only framework available. To fully round out this strategic toolkit, leaders also rely on alternatives like the GE model and Ansof's matrix, with each offering a slightly different lens. While the BCG matrix relies heavily on market share and growth rate, the GE model provides a much more nuanced look at overall industry attractiveness and competitive strength. Ansof's matrix, on the other hand, zeroes in on strictly the risks associated with product and market expansion. Having these different maps allows executive teams to look at their varied portfolios from multiple angles, expertly allocating resources to maximize strategic advantage with total confidence.
So, we've covered the analytical groundwork, the 4 strategic moves, and the portfolio tools required to deploy your resources effectively. But listen, a strategic playbook is ultimately only as good as the player utilizing it. So, I want you to look at your own company, your own department, or even just your daily projects through this exact lens right now. Ask yourself, are you currently nurturing a high-potential star, or are you wasting valuable resources feeding a strategic dog? Use these frameworks, map your next move, and I'll see you in the next explainer.